Good morning, friends. Today we are venturing into very interesting topic about short market, that is options. Options are predominant in market. They are very dear to market. It's a hit superstar of market. We have in earlier lecture we have learned about derivatives, which derives its value from an underlying asset. We have learned that there are four types of derivatives. They are forwards, futures, options, and swaps. That the options are more flexible, more speculative, more risky. However, the reward to risk ratio is also very high. Going by data of market, 80% of per day market turnover in rupees 1000 crores comes from options or derivative markets. 20% of per day rupees 1000 crore turnover of market comes from cash segment and a physical delivery segment. Here is a word of caveat that the data shows that 90% of demat accounts are closed in first 3 months of their operations due to losses incurred to options trading. These losses are due to not understanding the concept fully, not understanding the methodology fully, not understanding the rules of business fully, just going by some success stories of other people who never tell their own failure stories, just employing their hard-earned capital in very risky positions and hence incurring losses. It's a sincere request to use options knowledge, to gain options knowledge first, and then only venture into this trading business. Otherwise, be an investor that is more suitable than this options one. Now, some important jargons about these options are strike price. Strike price is our price of entry. Then target price is our intended targeted price which we wish to achieve. Then premium is the difference between last traded price, fondly known as LTP, minus the strike price. This premium is the facility to common investors to venture into costly stocks with some basic premium. It's similar to LIC premium. LIC business runs upon the premium collected from say 100 people. The claims ratio comes to only 5 to 7%. This 100 people's premium funds the claims of 5 to 7 people, and this is how that business runs. In a similar way, premium is collected from all the traders, and they are given opportunity to trade in all the costly stocks with the very least capital availability. Now, coming to call and put options, there are two types of options: call and put. Call options gives the right to buy but not an obligation to buy. It's only a right. You can exercise it or you can refuse it. Further, they are divided as call buyers and call sellers. Call people are basically bearish people. They believe in upward trend in the market. They speculate that market will go up. Call sellers are bearish or sideways people. They have an obligation to sell in case their contract is squared off and they doesn't get their target done. Both need to pay premium. Call buyers can make unlimited profit, but the loss is limited to the tune of their premium only. But call sellers can incur unlimited losses and they have an obligation to sell at lower price. Now all about put. Put are basically bullish believers. They believe that market will fall down and they will make money by falling market. There are also two types of put buyer and put sellers. Put buyers are basically bearish. Put sellers are bullish. They are just exactly opposite to what call people do. Put buyers have a right to sell but not an obligation. Put sellers have an obligation to buy at higher prices. Put sellers make unlimited profits because they believe in falling market. Put buyers make loss because they have compulsory to buy at higher prices. This is the nature of the businesses, the trading is. Now, where come this data comes from? Who gives the data? NSE, National Stock Exchange, makes this data available. The data is available in very segmented manner. One segment connected to other, one n segment connected together. Hence, it is called an chain. This data is available at NSE website. The few jargons of this to read this data are ITM, that is in the money, OTM, that is out of money, ATM is at the money. Now, while we are moving forward, now we have to understand the settlement dates. Positions are taken per week, per month basis. All the settlements of weekly settlements are done on every Thursday. All the monthly settlements are done on last day of the Thursday. Settlements done is known as squaring off or closing of open contract. We have seen these OIs, open contracts. All the contracts are closed on the settlement date, that is also called as squaring off. Now I had shared a typical screenshot of what option chain looks like. It suggests a train of data arranged in some peculiar fashion. Each figure tells you a different story. Each figure we need to read these figures. We need to learn to understand these figures. We need to make strategy for entry point and exit point depending upon personal goals, personal target regarding this trading business. Hence, we have to be familiar with the option chain chart. Now, the chart is divided into two parts, call side part and put side part. The premium, the value of the premium, the changes in the premium, the lot size, the in the money at the money levels are also seen in the chart. And we have to learn some market Greeks, as it is called in market language. These Greeks are nothing but Greek alphabets, basically Greek alphabets, which have some mathematical and statistical significance about that chart, which tells about the volatility, the movement, the expiry, speed of expiry, the gain of appreciation of premium, the loss of premium, etc. These are called as delta, gamma, theta. These are separate issues of discussion. It is venturing into some diving deep into this knowledge. Better way to stop here today, because just you have to digest the first concepts. Some concepts are really very slippery. We have to read it, we have to ponder it, we have to think it some 5 to 6 times, then and then only they are understood. It is a good business. It is a good trading, is a good business. We have to first train our minds, our brains to be a business oriented mind and then to venture in it. It's not a part-time business, because every time you take a position, you have to pay premium, you have to top up the premium, and when our position is not made of, is not achieved, our premium is lost, and that is the basic loss in this whole cycle. Hence, take informed decision, be peculiar, be inquisitive, be knowledgeable, and then only venture into this field. In next coming sessions, I will be dealing with more detailed market Greeks and ITM, ATM and OTM levels, or basically the option chain charts only. I try to keep it as simple as possible for you to understand what we are dealing with and how people multiply money, and also how people lose their money at a very lightning speed. So do take care. Thank you. Have a good day.